In this lecture, we are going to study about fundamental concepts of managerial economics. In that, we are going to have a detailed explanation of incremental concept. Managerial economics is both conceptual and metrical. It is useful to identify and understand some basic underlying concept of the subject. The contribution of economics to managerial economics lies in certain principles. There are 6 basic principles of managerial economics. 1. Incremental principle. 2. Concept of time perspective. 3. Discounting principle. 4. Opportunity principle. 5. Equimarginal principle. Incremental concept. This concept is most frequently and important concept used in managerial economics. This incremental concept is closely related to marginal cost and marginal revenue. Marginal cost in the sense the additional cost incurred by a firm for producing an additional units of product. So marginal revenue is the additional revenue incurred by the firm by sale of additional unit of output. Incremental cost involves estimating the impact of decision alternatives on costs and revenues, and also emphasizing the changes in the total cost and total revenue resulting from changes in the prices, products, procedures, investments, or whatever else may be at stake in the decisions. So as said, incremental cost is a combination of incremental cost plus incremental revenue. So as said, incremental concept is a combination of incremental cost plus incremental revenue. Incremental cost is the additional cost incurred by a firm as a result of accepting an additional project or accepting an additional production of a product. Incremental revenue is the profit obtained by the acceptance of new project or new product or increased in the sales of the product. So incremental cost may be defined as the change in the total cost resulting from a particular decision. Incremental revenue means a change in the total revenue resulting from a particular decision. According to incremental concept, a decision is obviously a profitable one if it increases revenue more than the cost. So that is, the cost should be less than the revenue. Revenue should be high, or the rate of increase in the revenue should be more than the cost. Second thing, it reduces the cost more than revenues. That means minimizing of cost. Your cost should reduce in a much faster way than that of revenues. It decreases some cost to a greater extent than it increases other cost. Fourth one, it increases some revenues more than it decreases other revenues. Incremental concept. Some businessmen hold the view that to make an overall profit, they must make a profit on every job. Consequently, they refuse orders that do not cover full cost, labor, materials, overhead, etc., plus a provision for profit. Incremental reasoning indicates that this rule may be inconsistent with profit maximization in the short run. A refusal to accept business below full cost may mean rejection of a possibility of adding more to revenue than cost. The relevant cost is not the full cost rather than the incremental cost. So let us understand incremental cost with the help of an hypothetical example. Suppose if a company receives an order and it is estimated to bring an additional revenue of 5,000 rupees, wherein the cost for the new project are estimated as labor cost at rupees 1,500, material cost at rupees 2,000, overhead cost at rupees 1,800, as it is calculated as 120% of labor cost. This is based on company's policy The percentage can be varied accordingly to the each company. Selling and administrative expenses are estimated at rupees 700, that is allotted to 20% of labor and material cost. So the total cost will be 6,000 rupees. In a mere point of view, it seems that this order is not profitable. That means the total cost incurred here is 6,000 rupees, whereas it gains the revenue of 5,000 rupees, which seems to be not profitable for a business. So the order at first appears to be unprofitable. However, suppose if there is an idle capacity which can be utilized to execute this order, then the order can be expected or accepted. That is, if the order adds only 500 of overhead cost, in the sense that is the added use of heat, power, light and added wear and tear on machinery, the added cost of supervision, etc. And 1,000 by way of labor, because some of the idle workers who are already on the payroll can be deployed without any additional payment to the new project. And no extra selling and administrative costs, then the incremental cost of accepting the order will be as follows. So, after the changes, amendments given, the labor cost will be rupees 1,500, material cost will be rupees 2,000, overhead cost will be rupees 500. That is the same, it is calculated at 120% of labor cost, wherein there is no selling and administrative expenses as they are going to use idle capacity. According to the new corrections, as advised by the economists, the labor cost will be rupees 1,000, material cost will be rupees 2,000, because idle labor has been deployed from the already existing payroll to the new project. So the labor cost reduced from 1,500 to 1,000. Material cost remains the same, rupees 2,000 rupees. Overhead cost came down to rupees 500. And selling and administrative expenses, which are allocated at 20% of labor and material cost, are treated as nil because of utilization of idle capacity. So the total cost comes around rupees 3,500. So according to the advices given by the managerial economists, the costs were revised as labor at rupees 1,000, material at rupees 2,000, overhead at rupees 5,000, selling and administrative costs should be nil as they are using idle capacity. So the total cost came down to rupees 3,500. While it appeared in the first instance that the order will result in a loss of rupees 1,000, it now appears that it will lead to an addition of rupees 1,500. That is 5,000 minus 3,500 to profit. That means after the corrections made in the cost estimation, based upon the idea of utilization of idle capacity as a motto of optimum resource allocation, the firm can enjoy a profit of rupees 1,500. So incremental reasoning does not mean that the firm should accept all orders at the prices which cover merely their incremental costs. So they can do a cost adjustments and do a better utilization of resources and take up the new projects. The acceptance of rupees 5,000 order depends upon the existence of idle capacity and the labor that would go underutilized in the absence of more profitable opportunities. So earlier studies of excellently managed large firms suggest that progressive cooperations to make a formal use of incremental analysis. It is, however, impossible to generalize on the use of incremental principle since the observed behavior is variable. So, it is the duty of the managerial economist to understand the order and their company's ideal capacity situation and their company's policies, so that which will make him to not only concentrate on incremental cost obtained by the product, but also can do an efficient utilization of existing resources and make the order more profitable. In such case, all new projects can be taken up by the manager and they can have high profits.